Good morning. Welcome to Trading Hour. It's a Monday morning. I'm Reema Tendulkar. With me is Sonal Bhutra, and the large caps are marching on after a very range-bound, quiet sort of a week. Today, Monday morning, the Nifty's zoomed past its 50-day moving average and now closer to 25,100. It's over 100 points up on the Nifty. The Sensex has gained close to about 450 points. It's just the mid-caps which continues to lag. And I think even last week, the mid-caps underperformed, and that trend has continued.
That is actually. And, you know, there was a brief period in time when mid-caps and small-caps rallied, but they could not continue that rally. Today, there's some more declines that we're seeing in the mid-cap space. If we talk about what's doing well, as Reema said, the large caps, they continue to do really well. And banking names, they are contributing in how to the gains that we are seeing today. So we have Kotak Mahindra Bank, that's the top gainer now. That's followed by IndusInd Bank. We have some of these IT names which are doing well as well. So Tech Mahindra is one of them. Infosys is the other one. Even an HDFC Bank is doing really well, a big heavyweight on the Nifty, and that's lending a lot of support there. So all these major and bigger names contributing to the large cap gains that we are seeing today. But of course, we do have a lot of earnings reactions which are trickling in, and that is something which is setting the mood of the market as well. In fact, Avenue Supermarts is one of them. It fell after a weak set of quarter 2 earnings. Growth in online grocery formats in metros is taking a toll. Brokerages have turned bearish on the stock. Let's get in Mangalam now. He's here to tell us more. Mangalam?
Well, you know, if you look at just the numbers of Avenue Supermarts as well, it looks like it's the beginning of a structural decline in the company's margins. Why do I say that? Because one, the company's called out categorically that there is an impact on online grocery formats in the large metro D-Mart stores. And secondly, while they are also ramping up their D-Mart ready business, it may mean, you know, incurring costs. And if they even have to go ahead and increase their stores as the street expects them to, they would have to increase some costs as well. As a result of which, the revenue of the company, which we already knew was higher by about 14.5%, 14,444 crores on a consolidated basis. The EBITDA grew by just 8.8%, which implied a margin decline of 40 basis points. And the net profit on the back of that grew just shy of 6% as well. The gross margins of the company, while they improved quarter on quarter by 20 basis points, it was a decline of almost 70 basis points year on year. D-Mart Ready, which grew around 24.5% in the second quarter to almost 400 crore per quarter in terms of a revenue run rate, actually had to make an EBITDA loss of 11 crores as the company is expanding the quick commerce vertical for this business itself. What the street didn't like in particular was, the like-for-like revenue growth coming in at 5.5%, which is at a multi-year low. And this compares to 9.1% in the previous quarter itself. So there have been a slew of brokerage downgrades coming in as well. Case in point, something like a Morgan Stanley, they've downgraded the stock. The target price has been cut to 3,700 rupees. They believe that, the management commentary has put a doubt on the 20% growth algorithm that the company was focusing, and this could lead to further derating. The stock trades at around 60-62 times 1 year EV to EBITDA as well, so not particularly cheap. CLSA too has cut their earnings estimates by around 13 to 15%. JP Morgan has downgraded the stock. In fact, they've lowered their same-store sales growth forecast to about 4 to 6%, and as a result of which the EBITDA and net profit estimates are down by 8 to 10% as well. And Goldman Sachs says that the rapid scale-up of Q-commerce is likely to continue, which will only impact Avenue Supermarts going forward. And this is a trend that, the management had called out as well when they spoke to us in May 2024.
And what's the valuation, Mangla?
At D-Mart right now, it's close to around 75, 76 times 2-year forward earnings.
Okay, thank you very much for that. And, even after the downgrades that we've seen in the current quarter, there are brokerages who believe that downgrade risks persist for the next 12 months too. So IFL says that perhaps it will take about 12 months for a new equilibrium to set between companies like D-Mart and Q-commerce. Until then, we could see more downgrades. But the big, focus point today will be Reliance Industries. It reports earnings today. Numbers come out post-market hours, close at about 7:30 p.m. On a sequential basis, the company is expected to report a steady set of earnings, for the quarter ending September. But now let's deep dive into the individual segments and find out what the key expectations are from retail, oil and gas, and the telecom business. Mangalam had, done this piece on the retail segment and what the street is expecting. Oh, Mangalam?
Well, for Reliance Retail this time around, footprint expansion as well as footfalls and improved sequential consumer sentiment may lead to the growth that we will look for in Reliance Retail business. What we'll also need to watch out for is the performance of their newer formats, which the company has been growing, be it something like a Tira, something like a U-Star, or even their beverage business, Campa. along with the FMCG business Swadesh. So what are we expecting this time around? An 8% revenue growth is what the street is working with. The EBITDA would be flat year on year. So while you're looking at a near $10 billion revenue top line coming in from Reliance Retail this quarter, EBITDA close to around 5,900 odd crores, which would mean that the margins would hold around that 7% mark as well. But apart from this quarter's numbers, what will be important is what the management has to say in terms of an outlook for the festive season, because for the retail industry, the third quarter is extremely crucial. And this at a time when the company already has been, setting a lot of stores on the ground, a lot of footprint expansion, along with a lot of expansion of the digital business as well. Nearly 18% of their revenues coming from the new commerce and digital verticals. So how that pans out is something that we will be tracking very closely for Reliance Retail too.
Thank you very much for that. So now for the telecom business, it's expected to be a very strong quarter. Now the telecom business was reporting flattish, very muted kind of a revenue growth. But this quarter will be the first quarter post the tariff hikes taken by Jio and the industry in early July. So the tariff hike for Reliance Jio was about 20%, and this will drive a strong quarter for Reliance Jio. So on the top line, we're expecting a 7% revenue growth, EBITDA margins to expand by 100 basis points to come in at 53.6%, and it will drive a 13% increase in the company's profitability. The key driver of this will be the tariff hike, and the tariff hike impact typically plays out for the next 2 or 3 quarters. So this will be quarter one, but depends on when your recharge cycle is. Even the subsequent quarter does have a benefit. So that's the reason for the strong quarter. ARPUs too, and ARPUs for the company, average revenue per user, have been stagnant for the last many quarters at about 181.7, but this quarter it will suddenly show a jump of about 6.5% to 193, 194. But that said, typically when there is a sharp tariff hike, there is some subscriber churn, subscriber loss which takes place, because some people who may have had 2 SIM cards may give up 1 SIM card because of the higher cost of ownership. So generally, when there is a tariff hike, what we've seen is that there is some subscriber loss. So that's a number we will track. But outside of that, I think Jio is going to have a very strong quarter driven by these tariff hikes.
And Jio will support the numbers that we'll see this time around, because if we talk about the auto chemicals and oil and gas business, especially auto chemicals business, because the macros have been very weak for the global industry as a whole. And that is something that could continue as well, because Singapore GRMs are expected to be weak at $3.6 per barrel, which compares with the similar levels seen in the last quarter. Asian diesel spreads, they fell 8% because of weak Chinese diesel demand, something that we have been talking about for a long time. There have been refinery capacity additions that we've seen as well. That is something that has further pressured margins. And gasoline spreads have also fallen by 15% on a sequential basis. Petrochemical margins, they have continued to languish, and they are at 15-year lows. And that's the reason the estimates suggest that there could be a decline. Jefferies, for instance, says that EBITDA will be down 20% on a YOY basis, 1% sequentially to come in at 12,969 crore rupees for oil to chemicals business. So that's the kind of view that Jefferies has here. If we talk about the oil and gas business here, this business has continuously done very well for the company. But this time around, it will be a decline on a sequential basis, but it will be up 5% on a YOY basis. It will continue to do well. The quarterly EBITDA run rate of 5,000 crore rupees. The KG basin outlook is something we'll be watching out for, because production has increased to peak levels. But yes, O2C could be the reason there could be a decline, and that is because of weaker macros that we have been talking about.
Okay, thank you very much for that. So that sums up the expectation for big boy Reliance Industries. The stock per se has struggled a bit over the last couple of days. I think if you pull up a 10-day chart or a 2-week chart of Reliance Industries, you would see it's going into the earnings a bit subdued. I think in the last few days, it's lost nearly 7%. That's the today's chart. But if you pull up a 2-week chart, you would see the kind of fall that it's seen from levels, in the last few days. We'll slip into a break, we'll come down, and the management of Purvankara will join in to discuss the company's Q2 business update and the outlook for the coming year.
Welcome back. You're still tuned into Trading Hour. Let's talk about some corporate conversations then. Purvankara gave out its Q2 business update. The company's pre-sales fell 17% YOY. It was an increase on a quarter-on-quarter basis. Let's decode the business update and get a sense of how the quarter has panned out for the company and the outlook going forward. We are now joined by Abhishek Kapoor, the Group CEO of the company. Abhishek, good morning. Thank you so much for joining in. Well, you know, it's an increase on a sequential basis, but if we look at the sales value on a YOY basis, it's a decline. Realizations are down 1% as well. And in the first half, your sales value is down 10% on a YOY basis. Can you explain what went wrong here and what is the outlook for FY25 here from here on?
Look, thank you for having me on the show. And really, nothing went wrong. What's really happened is last year we had about 3 million square foot of new launches, which we have missed. But if you see on sustenance basis, both our realizations and sales numbers are much, much higher. Having said that, we have given a guidance of bringing in about 12 plus million square foot to market this year, totaling including earlier projects of new phases to about 17 million square foot. The company is on track for those launches in the upcoming quarters, which is Q3 and Q4. In fact, Q4 being the largest one. So we're pretty excited for the rest of the year. But if you look at the data a little more in detail, we are sold about 2.84 million square foot this year already, versus about 3 million square foot with the 3 million launches last year. So overall, I think it's pretty good. The collections have gone up. If you look at on a first half yearly basis by 27%. So we are really focused on the cash flow. Ultimately, that's what counts, how much money is coming into the company. So we continue to focus on that. But, you know, with the new launches, we are expecting, you know, pretty good numbers for the rest of the year.
So 17 million square feet of new launches for the full year holds as a guidance. How much has been done so far in H1? And even your guidance, you said in terms of areas sold, you're at 2.84 for the first half. For the second half, what would that number look like? So both those numbers.
Look, you know, as I said, we are on track for the new launches. We don't really give guidance on the numbers in terms of what we are expecting as a sale number or sales velocity. But having said that, traditionally, if you look at it, last year we sold about 7.26 million square foot, which achieved 5,900 crores of sales. This year, as I mentioned, we've already done about close to 3 million, 2.84, and we have a substantial launch which is coming in Q3, Q4. So on those lines, as I mentioned earlier, we are expecting that we should see robust numbers coming in addition to the sustenance sales. So as I said, because of sustenance is where we are, but new launches should take us to the next level in terms of pre-sales numbers. And of course, that will have a resultant impact on cash flows. But, you know, I'd like to just bring to your notice our acquisitions, because last year we sold about 7 plus million square foot, and we have acquired more than 5 million square foot with a GDV potential of over 10,000 crores. And I think that's been the focus, because we want to plan for not just this year, which is already announced, but also for the next year and the year after, from the growth perspective and consolidation perspective. So, you know, from that point of view, that's been a great news for the company.
Okay. Now, Abhishek, just to follow up on that, you said you're on track to achieve that 17 million square feet. But what Rima meant to also ask is how much have you launched so far? Just trying to understand how much launch will come in the second half of this fiscal.
All of it, more or less, you can assume is going to come in the rest of the fiscal. All of it.
17 million square feet.
Almost all of it will come in the third and the fourth quarter. Very small, about we would have launched not more than 1 million square foot so far.
But what makes you so confident? Because 16 million square feet is a big number. Which are the geographies where you're looking at those launches, and which segment will it be? Will it be in affordable? Will it be in the Provident, or will it be Purvankara?
So, you know, that's the advantage with the group, right? We have 3 brands. We have Purvankara, Provident, and Purvaland, and we have multiple geographies. So what is exciting for us is the fact that we're not one geography focused or one, you know, category focused. In that sense, we have a whole range of product, including Purvaland, right? So, yeah, of course, majority of the launches are in Purvankara, and they are in South and West. So, for example, in the West, in Pune, we have a project which will get launched. In Mundwa, in Bombay, we will have 2 projects, which is in Thane and Lokhandwala. In the south, we will have multiple projects between Bangalore, Chennai, Kochi, and Coimbatore. So, all of these are on track. And because we are so distributed, and the team, we have the bandwidth and the structure to take these to market, which we have demonstrated in the past, makes us confident that we'll be able to achieve our numbers. We are watching it every day in terms of where we are progressing on the plan sanctions and the launches, because these are all lands paid for. We don't have to do anything here. We just need to get these off the ground. And so the team has been focused. All of us have been focused on those. So you should see the numbers come through.
Okay. You also acquired 3 acres of land in North Bengaluru earlier this month. What's been the total land parcel that you've acquired so far, and what is the plan with respect to more land addition?
See, this year, if you see, we have acquired about 5+ million square foot of sellable area with the GDV, as I mentioned, of more than 10,000 crore potential. These are, majority of them have been between Bangalore and Mumbai. At this point in time, South Bangalore, North Bangalore, we have acquired a few land parcels. And we are expecting that we will continue that momentum. There's a robust pipeline of business that is currently underway. From our perspective, the way the process works is that once we have closed a land transaction, to the time through the due diligence, and by the time we do the registration and announce, it takes a journey. But yeah, as I mentioned, we have closed more than 5 million square foot, and with a GDV of more than 10,000 crores.
What does it do to your debt, Abhishek? Can you give us the absolute number? How much would it increase by? How are you going to fund it? Because there's the pending QIP as well. Will you be using those funds for this?
Look, so we are at about 2,200 crore net debt number, right, as of now, as of last quarter. And, our focus is to continue to maintain our debt levels at the net debt level. And the other parameter that we look at is clearly the, debt per square foot number. So as more and more projects get launched, and I keep talking about it, is because debt is a relative to the quantum of business you do. With these additions, I'm quite certain that the net debt per square foot of area under development will come down significantly. Having said that, yes, QIP is very much approved by the board and the shareholders, and it will definitely be on the cards at some point in time. And yeah, the idea of using the QIP capital will be towards retiring debt further. So we'll continue to ensure that we have required capital both from internal accruals as well as multiple capital opportunities that we have. We closed a HDFC transaction this year, which was 1,150 crores of platform transaction. And then, of course, we have our own AIF, and we have a bunch of other transactions which are currently ongoing for capital raise. So we'll expect that between all of this, capital should not be a challenge at all for the organization. Of course, with the increased collections, which is key to the business. We are collecting at a run rate of over 1,000 crores, and we're expecting it to go up with these new launches. I think that will also enable us to continue to scale our acquisitions.
Abhishek, thank you very much for joining in. Look forward to the next conversation when you report your numbers. Get into a break. We'll come back and discuss technicals with Soni Patnaik. Welcome back. As promised, Soni Patnaik from JM Financial Services is with us now. Soni, morning. Thank you for joining in. What would the stock calls be?
Hi, good morning, Reema. Thank you so much for having me on your show. So the first pick would be in Coal India. One can buy in futures in Coal India around 500 on any declines up to 500. Keep a stop loss of 492 and a target of 515 and 520 can be seen. The second buy pick would be from the auto space, Hero Motors, which is giving a good reversal pattern from 5,500. One can buy Hero Motors in futures around 55.60, keep a stop loss of 5,500 and a target of 5,700, 5,720 can be seen.
All right. Thank you so much, Soni, for joining in as always with your technical picks. We'll slip into a short break now. When we come back, we'll discuss the market fundamentals with Deepak Ramaraju of Shriram AMC. Stay tuned for that. Welcome back. You're still tuned into Trading Hour. Deepak Ramaraju from Shriram AMC is joining us now to discuss market fundamentals. Deepak, good morning. Thank you so much for joining in. Well, we're talking on a day when large caps seem to be outperforming the mid caps and small caps. Do you think this is a trend that we'll continue to see now, that large caps will continue to outperform? September did see ebbing of flows in large cap mutual funds, but what are the trends suggesting now?
Hey, thanks for having me on the show, first of all. And definitely, yes, we are seeing some kind of outflow that had happened in the FIs in the recent past, that because of the Chinese stimulus. So that actually impacted the underperformance of the large cap. But yes, now we can see some kind of reversal also possible, because the Chinese stimulus is going to be kind of muted one to a large extent, because it's going to be, there's no time bound there. So you can expect the markets to reverse to a certain extent, because FI flows can come back to India in the medium term. So that's where it's kind of, we are seeing kind of outperformance coming. But yes, it's early days. We can't say that the large caps are consistently going to outperform in the longer run, because the mid cap and small caps still are going to have some steam left. So that's what my consensus is on about that.
Deepak, hi. You track many, you manage many funds, aggressive hybrid, a flexi cap fund, ELSS tax saver fund. And some of the top holdings are common across these funds. You've got a Bharti Airtel, Sun Pharma, Trend, Bajaj Auto. These are stocks which are in the top 5, I think, across most of these funds. So what is the approach towards stock picking? Why have you selected these particular stocks? And, going ahead for the next 6 months, because we have general elections, crude has been a bit volatile considering what's happening in Middle East. We've got US presidential elections. What would the approach to investing being?
So we as a fund house is more of a fundamental fund house. So we run quant strategies around and then use fundamental overlay over and above the quant strategies. So that's why we see some kind of overlap of stocks between different funds. So the large caps typically have some overlaps in those names, and these are mostly driven by the quant strategies. And the sectors that we currently like are more driven by the autos and as well as the healthcare. These are the top 2 sectors where we are currently overweight amount. So that's the reason you're seeing some kind of overlap of the stocks. So that's it. So.
Okay. And in the second half of the year, do you think the bias of the markets could be a little negative? Would it be positive given the factors like Q2 earnings have not started off on a great note? They've been okay, or at least even the pre-quarter updates that we've got through. We've got state elections. How would you balance these, risk factors going into the second half of the year?
So definitely, yes, the earnings is not going to be all that great in the second quarter. So we are seeing some kind of marginal improvement in the EBITDA margins, or the margin levels out at the bottom line. You might see some kind of growth. The top line is seriously getting kind of a bit stressed as of now. That's something which is visible, especially in the kind of financials. You're seeing kind of stressness building up in the financial space. NBFCs are still better off compared to the banks, and the private sector banks are still better off compared to the public sector banks. So that's one, because we are seeing kind of pressure coming on the deposit side on the banking space. So that's another factor that we need to be watchful about. So that's going to impact on the growth of the banking space. And we are kind of underperforming on the banks as a whole, as a sector, and as well as if you look at the stock performance as well, we have been seeing the banking being kind of underperforming because of this. Yes, today we might have seen a bounce back in this space, but it's early days. We need to see a consistent growth in the deposit franchise has to improve for all these banks. So when the balance sheet gets balanced out, especially on the liability side as well. So until the growth happens on the liability side, they can't grow much on the asset side as well on the banking side. Now, that's on the banking space. But we are seeing a growth coming in the mid single-digit levels, especially in case of your auto ancillaries or auto sector, or for that matter, your materials, or for that matter, your IT sector is going to be in the mid single digits kind of a growth on the top line. But the bottom line seems to be better off, because you're going to see some kind of improvements in the margins, and as well as the operational efficiency has been improving, especially on the bottom line, especially that's going to reflect in the bottom line of these companies. So auto ancillaries, IT is relatively kind of early stages of recovery that we are seeing there. Yes, the risk is there from the elections, especially the US election, which as of now it's kind of clearly between both the parties is not clear kind of majority until we see the outcome of the elections. So that's going to give more guidance on what's going to happen on the policies of the US side.
You know, the other trend that we're noticing right now, and this is very recent because DMart suggested in the results that there's a lot of online competition, and that's the reason why the growth hasn't been as strong as they had anticipated. Is this a trend that you think will continue to hurt the FMCG companies, and you would look at some QCom players or players with online presence, and that could take some time before there's a recovery back to offline or brick and mortar segment?
See, the brick and mortar still definitely is still facing some kind of headwinds there. So definitely it's going to be under pressure. The consumption theme is strong. So it's not that it's not consistently weak or something, but yes, the rural demand is yet to pick up in a big way. Until the rural demand picks up in a big way, you're not going to see that kind of growth coming in for this the brick and mortar kind of stores. The quick commerce, yes, because of the festive demand, we see some kind of uptick in volume, but it's not going to be sustainable in the longer run. So it's kind of early days of recovery that we are seeing, yes, on the rural demand. But you need to see a sustainable demand in the pickup in the rural demand. That's when this kind of stores performance will start going up. The same store sales will start picking up at that point of time. So you need to wait and watch for how the demand in the rural side is going to pick up over a period of time.
Indeed. Thank you very much for your perspective this morning. Get into a break. We'll come back with more on the market. Stay tuned. Welcome back. Wipro is one of the big movers today on the way up. In fact, now it's the top Nifty gainer with a rally of more than 2%. This is in anticipation of a bonus issue when the company declares its results on Thursday. That's the 17th of October. The last time the company did a bonus issue was in 2019. That was a record date. The record date for this bonus issue is not announced, but the board will meet and they will deliberate on that. It will also be the first one under the new CEO. But a quick word in terms of numbers. After 6 quarters of a top-line decline, according to the CNBC TV18 poll, this time we could see a positive growth. The company, remember, has been struggling in terms of growth. They had a new CEO, Srinivas, who came on board a couple of months back. And the hope is that the company is now back to a positive trajectory. So 0.4% is the revenue growth expectation according to our poll. And the key to track is that whether this recovery continues in the Q3 numbers too in terms of the guidance. But the one to watch today is going to be HCL Tech. As it declares numbers, HCL Tech reports their numbers post-market hours. I think the press conference is scheduled at about 6:30. In terms of a top line, dollar revenue growth is seen at 1.3%. Constant currency revenue growth will be seen at 0.6%. Constant currency, revenue growth is seen up 0.6%, and this follows a decline of 1.5% that we had in Q1. The company had already said that Q2 will be a growth quarter, but there is going to be a headwind because of one of their clients insourcing State Street JV. And Q2 will see growth in all geographies except the financial services vertical, which will recover only in Q3. Margins are likely to improve by 100 basis points, but this is after 2 quarters where margins had come under pressure. So this quarter, expect margins to recover. The wage hike comes in only in the subsequent quarter, Q3. Profits are seen up close to about 2.7%. Expect the company to hold on to its guidance, both on the top line, which stands at 3 to 5%, and margins of about 18 to 19%.
Okay, big numbers expected today. It's been a very busy week and will be the day for you as well, right? HCL Tech, there's Wipro, Reliance as well. But Sudarshan Chemicals in focus after the company announces to buy promoter entities of UBAC Colorants. The board is also going to consider fundraising on October 16. Vivek is here with all the details and key management takeaways. Vivek.
Well, that's right. So Sudarshan Chemicals, like we had reported on September 3rd, and on Friday, that particular news break got confirmed that the company is going ahead and going to acquire the colorants business as far as UBAC Global is concerned. Now, incrementally, what's actually happened is the fact that a board meet has been scheduled on October 16th. So the company will be looking at a fundraise, and this particular fundraise would most likely be via the QIP route or the pref route. The company also has kept debt issuance as an option. Now, apart from that, also keep an eye out on UBAC Colorants. So UBAC Colorants has gone ahead and told the exchanges that yes, Sudarshan Chemicals has acquired the promoter entities of Huback Colorants, India listed entity. So both of the promoters, one promoter holding close to 36.5% stake, the other promoter holding close to 17.8% stake. Both of these promoters will now be acquired by Sudarshan Chemicals. And, as for the rules, every time there is a change as far as the promoter entity or ownership is concerned, most likely there will be a triggering of an open offer. And that will be important to track as far as Huback Colorants, Indian listed entity is concerned. Now, when you're talking about, what brokerages are saying on this particular deal, Axis Capital says that they expect this particular acquisition to be value accretive. Number one, based on Huback's product portfolio, which actually has a higher share from the coatings as well as the corrosive business. And they believe this portfolio should be complementary to Sudarshan's existing portfolio. Apart from that, they're also saying it gives an expansion in the global network versus the company's earlier plain geographical presence, and also valuations are very attractive at 0.2 times CY23 revenue of close to 0.9 billion euro. Now, they also have a few risks that they've outlined. Number one is the efficient execution. That will be contingent on that. And also any contingent liabilities for the global entity. We had the management on our channel earlier today. They are saying that they will not be taking on any debt for this particular deal. They are saying that they get access to 17 manufacturing plants across 11 countries. It is a mixture of both an asset deal as well as a share purchase deal, and the fact that they don't get any debt is something that they reiterated.
Okay, all right. Both Sudarshan Chemicals and Huback Colorants are declining in trade. These stocks have done really well. Some sell-on news is what we are seeing on these two names today. Thank you, Vivek, for joining in with all those details. Time for a short break now. We'll get you more on the markets on the other side. Stay tuned for that. Welcome back. Well, it's time to get in some mutual fund action now. Hormaz is joining in. He's been tracking the big moves made by mutual funds in September. He gives us all the details as to who sold what and bought what. Hormaz.
It's interesting how most fund managers we have spoken to in the recent past told us about how large caps are the place to be in. But this recent mutual fund trend from the month of September presents a different, or shall I say, mixed picture. Now, this is according to a note from Nuvama Alternative and Quantitative Research. Start off with India's largest fund house, which is SBI Mutual Fund. Where have they bought new stake? Mostly the broader market names, GSPL, Shivalik Biometallics and JM Financial, which was in the news for regulatory issues recently. HDFC Bank is one stock where they have increased stake despite the underperformance recently, along with stocks like Indus Towers. Now, the fund has cut its stake in names like Bharat Forge and Cummins, along with ICICI Lombard. Now, HDFC Mutual Fund has bought a new stake in real estate players like Brigade Enterprises, an auto ancillary name as well, and they have also increased their stake in consumption-oriented names like Maruti, GCPL and United Spirits. Now, the fund has cut its stake in Zee Entertainment and Max Healthcare while making a complete exit from IDFC and Sadbhav Engineering. Now, Kotak Mutual Fund seems to be doubling down on IT names as it has increased its stake in Infosys and Wipro ahead of its results. Now, it has also bought new stake in an outperformer like Polycab, and the fund has cut its stake in Nifty heavyweight Reliance Industries and also in names like Samvardhana Motherson and, of course, Bharat Forge. A complete exit for Kotak has happened in stocks like Zee Entertainment, Asian Paints and Ami Organics. Now, here's a look at Axis Mutual Fund, who has bet on outperformers like Kalyan Jewelers and Oracle Financial, but has cut its stake in Nifty heavyweights like TCS, Reliance Industries and Tata Motors. It has also made a complete exit from PSUs like NHPC and ONGC. Now, moving on to Nippon India Mutual Fund, which has bet on a consumption stock like Nestle and increased its stake in stocks like Samvardhana Motherson. But look at the stocks where it has cut its stake: L&T, Bajaj Finance and Aditya Birla Fashion. Poonawalla FinCorp is the only stock it has exited. Now, Quant Mutual Fund, which has been in the news recently, has also bought stake in Nestle and increased its stake in Samvardhana Motherson, but has made a complete exit from Nifty names like TCS and Dr. Reddy's, along with Granules India from the broader market space. And lastly, ICICI Prudential, which has bet on some large cap names like HDFC Bank and L&T, bought new stake in PSUs like NMDC, but cut its stake in other large cap names like Reliance Industries. And the fund has made made a complete exit from stocks like Suzlon, Gulf Oil and GNA Axles. So what does this show? That there is no overwhelming consensus towards large cap names, as maybe these funds might be wanting these names to first deliver on the earnings front before a more constructive view emerges on these names.
Thank you very much for that. Interesting, names that pop up every time this data is thrown up. For the markets per se, it's now 25,150. When we started the show at 11 o'clock, the Nifty was hovering around 24,080, 24,090. So there has been a pickup of about 50 points on the Nifty, and mid-cap index is also now back in the green. With that, it's a wrap on trading hour. Thank you very much for watching.